right. Ready to go?
I think we got it.
All
Let's do it.
right. Thanks for being here on the first episode of the NAAIM Confidential Podcast. Today we have Matt Spangler, a single research group out of Oklahoma City. Great to see you. Awesome mustache, Sarah. Good to see you. I am Ryan Redfern. I'm president of NAAIM currently. Our NAAIM is largely an RIA and hedge fund group, people who manage money professionally for individuals. So for people who don't know what that is, Matt is an RIA, manages his own money, has his own strategies, has some neat concepts that he does. So I thought it'd be a great person to have on and talk about that sort of thing. But to start with, let's look at the sentiment index that we put out. There it is. Sentiment index, the weekly exposure index, which was up a little bit this week. I know Matt also contributes to this. So what happens is every week the membership is surveyed, and there's a feel for how invested each firm is. It's done every Wednesday. These are posted on Thursday, and these are now pushed out to YouTube and Twitter and Facebook, so you can check them out all there. So,
yeah, right. We've been getting good, but a lot of exposure from that, and it's been neat to see that in the media quite a bit more.
It has been, and it's certainly a great way to have get exposure to NAAIM, because I think not a lot of people know what this group is, even though we have a sentiment index, and people are more familiar with the AAIIs and the other ones. The fear and greed indexes, but this one's an interesting one too. So yeah, I guess we can jump on to
yeah, I was going to ask you.
Tell us about you.
We can certainly do that, but talking about the exposure index, let me just say, Ryan, what was your latest input on it?
Oh, mine personally, I was 80% this week.
Okay, I'm 100%.
Nice, you got me beat, but that's where that number, I think the number was 80, wasn't it?
Yeah.
Very good. So survey, that's the average allocation of most of our membership this week.
Very good. All right. No, that sounds great. And what I thought, Ryan, for this at least kind of inaugural show, the kickoff, we could start by just looking at last year and really comparing that to 2022. It's, for me, seeing it kind of, about it, hear about it, but seeing it visually makes a big difference. And so here, yeah, I'm assuming you can see my screen all right?
Yep.
Perfect. So I thought this was just a great chart to really kind of compare and contrast 2022 versus 2023, and just the vast differences it was on these various asset classes. And you just had some pretty extremes. Obviously, everything that was down in 2022 was up, pretty substantially for 2023. Commodities being the only one that was reversed, that was up in 2022 and down in 2023. So anyways, I thought I'd like to see it visually. I think this was pretty impactful when you kind of see it on paper and really see the difference between the 2 years. It was pretty stark difference. Another way to look at it, I pulled this chart, I thought it was interesting, looking at specifically the S&P and just comparing the winners and losers for the year for 2023. Because you see the index, you're like, oh man, it was up 20-some%. But over a third were negative for the year. Over a third of the 500 stocks were negative. So this is kind of a cool chart that just, again, visually kind of see where everything was for the year. Kind of have this zero line here, and everything to the left was negative and everything to the right was positive. And so just again, another way to visualize, I thought was pretty interesting.
Yeah, and for sure. And a lot of those were more than that was negative coming into October. At the end of October, it was way more than that. So there was a huge spike at the end that really changed the landscape very quickly.
Yeah, it was quite amazing. In fact, yeah, I'll show you another chart that'll show that. Of course, we all heard about the Magnificent Seven, right? And how it was leading the way, and it truly was. This is the seven, those seven stocks compared to the rest of the indices, the NASDAQ, the S&P, and the Dow Jones, and just, no comparison. It's pretty incredible, just the return those seven stocks were able to produce. Another way to look at it, is just comparing this again, just the 7 stock compared to the S&P itself, and then compared to the other 494 stocks. And this is what you're talking about, right here.
Yep.
I mean, the index, if you take those 7 out, the index was actually negative for the year. I mean, quite incredible when you visualize it that way and just look at it. So even though it ended up up 24%, the index did. You take those 7 away, and at one point in time it was negative. And of course, yeah, what a run those last 2 months to finish up the way it did. So, anyways, I just thought it was interesting, and just being able to see some of those visuals, I think, is pretty impactful. And when I think about, those 7 stocks, technology obviously was really the driving factor, these growth. This is a kind of just more of a fun chart I saw. I don't know if you've seen this or not. How long it took top apps to hit 100 million monthly users, right?
Uh-huh.
Pretty incredible. So Instagram, it took 30 months, right? Over 2 years. Here, Chat GPT, 2 months. Wow. Unbelievable.
Yeah.
It took 2 months for them to get 100 million monthly users.
That's unreal.
So just goes to show just the impact that particular software is having. Of course, that's all we heard last year, right? AI, and what all the difference it's going to make, and sure. Even in our business, right? And how it's going to manage money. It can impact money management and everything else, but let alone the rest of the economy. But it was it's pretty incredible.
Right. Absolutely. And yeah, it is in everything, and yeah, no thoughts on that. It was supposed to take over. Oh, and it was really the driving force between those 7 stocks. All of them have some sort of AI to them, if I recall, and that's really why they got driven up, and everything else didn't. It was a very AI-driven rally, and the S&P 7 is, as I heard some people call it as well.
Yeah, that's right. Do you see that slowing down at all this year?
Personally, I'm thinking we shift back the other way, like going back to your first slide. Everything that worked last year will probably not work the next, and I think we're going to do that flip again. And I'm certainly watching for that change personally.
Or do we see, those 7, they slow down, but just their momentum begins to pull the rest of the index up as well. And we see kind of more of not such a divergence within the index, right? I mean, there's always obviously you always have some winners and losers, but I don't know if we've seen this vast of a divergence within the index itself. And so will we see kind of more of common return amongst them, or back to normal, which if so, then maybe, I don't know if that's the upside, if it pulls them up, or if they all shift back down. So it'll be interesting to see.
Yeah, and certainly I know in that context, we'd look at the equal weight ETF versus the cap weight and see if that shifts. I mean, equal weight looked terrible last year. So if that does shift over, then we would have a more broad rally. I'd love to see small caps come in and pick this up, but they just can't seem to get going. They were starting to look really good, and they're just kind of rolling over the first part of this year. I'm not sure the participation is there to drive this higher. Not yet anyway.
Yeah, and talk about this in a little bit, but I think a lot of it's going to be contingent on what the Fed does, and I think that'll be a big driving factor this year as well. The only other stuff I was going to get into a little bit about kind of what I like to do a lot of trend following. That's kind of my main area that I focus on and utilize for money management is trend following and really fixed income, right? So we do a lot of fixed income, and so I was going to show just a couple slides on we talked about the Fed, and here's just a quick slide JP Morgan put out that just talks about what the Fed's going to do, kind of what the markets, the green here is kind of what the market's expecting on rate cuts versus what the Fed, their year-end estimates, and so the market's actually pricing in even more cuts than more dramatic cuts than what the Feds are saying. So we'll see what they do. I mean, I think again that'll be that'll I think have a pretty big impact on what the overall market does as well. And of course, for the fixed income, that obviously plays a big factor in fixed income as well, that I'm looking at. So another way to look at this. Go ahead. Yeah,
so
please.
With the if interest rates rising, do you see that being good for stocks or bad for stocks? I think there's a possibility that could be a more of a negative than people are talking about.
If they cut rates?
Yeah.
Yeah, because it's already priced in, right? And then maybe I don't know. I think that's a good point. It's kind of, I think there's definitely that possibility that it's already been baked in, and so when they actually do cut it, then they're more reacting, oh, did they cut enough? Did they cut too much? And
Sure.
and so it could definitely, I think, have at least initially a negative reaction to for the market.
Sure, because when I look at this, each time that the rates start falling, it's, for example, 99 to 2. That wasn't a good time. We started falling into 2007. We know where that led. We did in the end of 18. We know where that led. So I'm kind of curious if that leads to another, epic sell-off to some extent. I could be wrong. I'm not hearing people talk about this very much, but when I look at this chart, that's kind of what jumps out to me.
That's a good point. Yeah, I mean, you look at those time frames, I mean, those were tough years in the market for sure,
Right.
when they were cutting rates. So maybe this time's different, Ryan.
Oh, of course it is. Of course. Love it. But to your thing, if you talk about bonds, I mean, if falling rates should be good for bonds. So does that lead into where you were going to go next?
Yeah, exactly. And so really on looking more on this side of this chart, but you've heard, okay, what's the impact if they raise 5% or 1%, or if rates drop 1%, and just again to be able to see it visually. So if they do fall by 1%, this is the impact that it can have on the various types of bonds. We work a lot with high yield bonds, and so it would have potentially quite a good impact for the price of bonds. And so, I mean, obviously when they were raising rates, and I mean, it was a huge headwind for bond prices. And so, I mean, of course, that's why you saw the ag down such a huge amount in 2022. There was no place to go 2 years ago when stocks were dropping, bonds dropped equally, and so there was really no safety net other than commodities, and so and it's because of the rate hikes. So
Certainly.
So anyways,
it was the first time in a long time where the correlations matched up between stocks and bonds. Usually they were a good safety asset when the market fell apart. And last year it just did not work. Or not, sorry, last year, 2 years ago when we had the 2022 wreck, you couldn't go to treasuries to be a safety asset. I know people like Michael Guyad, who has won our NAAIM paper competition, had a tough year because that's what he did. He goes to treasuries as a safety, and it just didn't work.
Absolutely. No, bonds, of course, for 40 years, right? I mean, there was kind of this 40-year trend of bonds just doing well, and that relationship with stocks worked really well and is a great diversifier and a safety net for your portfolio and until 2022 hits, and it just did not provide that safety that everybody was looking for. So I think maybe with the rates, if they do begin to drop back down, that we might see might see that normalcy come back a little bit. So we'll see.
It would make sense.
It would, right? It would make sense. All right. So real quick, continuing on the next slide, just real quickly, again, one thing we look at is high yield bonds, and just looking at the spread, the yield spread there, and it's pretty low right now, but it does, I mean, it could, I mean, if you compare at least the last few years, it could go lower. And so, but there's not just a ton of room to go. But so, I wouldn't be surprised if we, high yields can continue to improve a little bit, and then we see some type of correction. But anyway, it's just something we watch when we're looking at fixed income is the yield spreads on that.
Sure. So are you looking for the high yield market to lead the stock market, or kind of to work in tandem with that? Or is it its own thing altogether? I find that some people use the high yield market to gauge the S&P or the NASDAQ.
Well, I think a lot of people do. It is kind of a telltale sign, right? If the market's doing well and high yields begin to become weaker and weaker, then that's a lot of times is a signal that, hey, there's could be trouble on the horizon. So a lot of times they move. We find that high yields bonds generally do move in tandem with the stock market, but as far as generally over a period of time, but yeah, a lot of times when you start seeing a little bit of divergence, and then all right, something's off in the market here, and you could be seeing a movement, to the upside or downside. But yeah, I think that's definitely can be an indicator, something to look at for the equity side as well.
Nice, thanks.
So again, you'd ask kind of what my philosophy is, or what we utilize. And again, I like to keep it simple. And so to me, trend following is simple. That's what we use predominantly, especially with the bonds. I just gave a quick example here on putting it on the high yield index. So great thing about bonds, and that we like them on the trend following, is because they just don't move quite as fast, near as fast as the equity indexes, or even individual equities. And so this is just an example of what we would use it. This is a 21-day moving average that we put on here. And so negatives to trend following is, yeah, you can get some whipsaws here and there, but for the most part, it keeps you out of the the big drops, and you catch most of the upper movement, which is really what we're trying to do. When we're working with clients, is we really just want to, if we can capture most of the upside and avoid most of the downside, then that's a big win in our book. And so to me, being able to add moving averages, and you can place some, if I'm looking like back in 2021 or coming into 2022, you can add various. All right, a lot of times we'll want to see a movement off the peak or off the trough. We'll want to see a certain percentage, maybe it's a percent move, 2% move off of the top or bottom before we, as a confirmation to what the trend is saying as well. And so adding some of those extra components onto just a moving average helps as well. And so we do that. A lot of times we will move in and like first signal might be a 50% buy-in, and then we wait for confirmation, and then buy in the other second half once the trend has been confirmed. And so just adding some layers to the trend itself, the moving average trend itself. So but the great thing about, in my opinion, trend following is that you don't it works great with bonds, but it also works great with equities. Here's an example of just doing a 10-month moving average on the S&P. So what I would say for anyone, that if you're not familiar with just moving average trend following, with bonds, typically you can use shorter time frame, and equities, you want to use a little bit longer time frame to avoid a lot of the whipsaws. And so, because obviously equities move a lot more volatile than bonds, and so we'll use a longer time frame for equities and a shorter time frame for bonds. But this gives you just a good example of how you can use a moving average even on something like the S&P 500.
Oh, sure, sure. And this reminds me of the work that Meb Faber did. It was
Yeah.
actually his BMT project for the Ivy, it became the Ivy portfolio book. Basically did a 10-month moving average on, I believe it was 5 different asset classes, and that's how the model ran. It's very simple, but it is effective. It does keep you out of the bad times. Um,
Well,
doesn't mean there's not whipsaws, but yeah.
yeah, there's whipsaws, and but again, for if you're working with individual clients, I mean, they mostly don't. They just say, "Hey, keep me out of the big
Mhm.
drops," right? And if I can capture, you know, 75% of the upside and avoid 75% of the downside, I mean, that's kind of a win-win, I think. And so most what I find is most individuals are happy with that. But to your point, here, let me show this, and then I'll give a little
Okay.
more info. So this is just actually some results. Like if you did implement a 10-month moving average on the S&P 500, going back to 94, this is kind of what it would look like, right? So the flat lines is what you're able to avoid some of those drops, and so it won't always outperform a buy and hold, but risk adjusted return is much better. And so instead of your max drawdowns up here, instead of having a 50% drawdown, your drawdown is only going to be 21%, which is
Right.
much more manageable. And so but so back to kind of my philosophy is, I like trend following because it's simple, it's easy to implement, and it works well for what I do on that side. Now, it's not going to be the best strategy in
Mhm.
every market scenario, right? I mean, there's going to be some market environments where trend following does not work very well. And I recognize that. And so for my own personal clients, I'll implement other strategies. I'll utilize other name members and their strategies. If they use maybe they have a mean regression type strategy, or whatever, some other type of sector rotation. There's obviously a lot of different types of strategies out there, utilize various technical indicators, and so I will utilize that to really get that diversification of management style for our clients, knowing that trend following is not going to be the answer every single year. And so I will want to diversify by utilizing some other types of strategies, and it's worked well.
Right. So have you found, at least I found this, so I'm curious if you have found this, that over the past, I'd say 4 or 5 years, especially the bond market, I have to trade more, be more quick. Like I used to be able to say, I could read early and pick a new fund and update it, and that was great. And then it kind of went to monthly, and then it kind of went faster. And then we had that almost like huge crash in 2020. And I found that I've got to be more on a daily basis looking at these things to miss catastrophic drops. And that's not something we saw before, say, 2018, at least not that I recall.
No, yeah, I think you're right. It does seem to be things move quicker now, and I don't know if it's just technology making it easier, more access, more people have access to the market than ever before, and so I think that probably plays into it. But uh, but yeah, no, I think you definitely need to stay on top of it, because it can change in a heartbeat.
Absolutely, absolutely. Well, cool. Uh, I guess we're going to wrap it up here. Did you have a favorite investment quote that you could share with us?
Well, it's an old one, right? But it's trend following. The trend is your friend. How about that?
Until it ends. Absolutely.
The
And then I
trend
guess
is
lastly,
your
how
friend.
does somebody get in contact with you if they want to follow you, or are you on social media? Do you do a newsletter? How do people follow your work?
So yeah, the best way, I mean, is I'm on LinkedIn, right? So that's probably the best way. Here, I'll throw my contact info on there as well. So
Awesome.
on the left there, phone number, email. I don't have my LinkedIn on there, but you can just search for me. I'm on LinkedIn. But yeah, love to chat. If you have questions on anything we've shared, I'm happy to chat about it. So
Awesome. Well, thanks so much for being here, Matt. It was great to talk to you. great to talk to the former president of NAAIM and how that's all going. I love what you're doing. Your strategy is really interesting. Certainly for me, being around a lot of people in NAAIM, I know what a lot of people do, and I'm really I know you do good work. So it's definitely worth following what you do. So I appreciate you being on today.
Well, thanks for having me on. It's a lot of fun, and look forward to catching this each week.
Absolutely.
Podcast.
This is now a weekly thing, so hope to see you next time. I don't know. I think Brandon is hosting next week, and
Awesome.
we'll see you then. All right.
Perfect. Thanks,
All right,
Ryan.
Thanks, Matt.